If you've got a 401k, an IRA, or you like to buy index funds, you might want to sit down, because whether you know it or not, a lot of your money is already in let me explain. Right now, about 40% of every dollar you put into a simple S&P 500 index fund goes to just 10 companies. 10, that's it. Those companies are NVIDIA, Microsoft, Apple, Alphabet, Amazon, Broadcom, Meta, Tesla, Berkshire Hathaway, and JP Morgan Chase. Together, they control nearly half the U.S. stock market's weight, and they're spending more money on AI than any group of companies in history. In fact, NVIDIA alone now soaks up nearly 8 cents of every dollar invested in an S&P 500 fund. 8% for one company, that's wild. And here's why everyone's so excited. Because in 2025, those tech giants are projected to spend roughly $330 billion on building data centers, GPU farms, and the massive computing infrastructure needed for AI. That's more than the GDP of Finland. But here's the catch. To justify their current stock prices, these companies would need to earn around $2 trillion a year in revenue. $2 trillion. Just to put that in perspective, in 2024, Apple, Amazon, Microsoft, Meta, Google, and NVIDIA combined made less than that, meaning the market is already pricing AI as if it's going to become the biggest money-making machine in history, bigger than every major tech company combined. That's where things start to get interesting. Because when expectations move faster than reality, that's how bubbles form. Now recently, Sam Altman from OpenAI said something that made investors' eyebrows shoot up. He mentioned his company was willing to commit about $1.4 trillion in spending to make AI reality. Someone in the audience asked, "Wait, how are you going to pay for that when your company made only around $20 billion this year?" Sam didn't love the question. He said, "We're doing well more revenue than that, and if you want to sell your shares, I'll find you a buyer." That response wasn't exactly comforting, because even if OpenAI doubled or tripled its revenue, it still wouldn't come close to that level of spending. So how can companies spend more than they make? Debt, a lot of it, and not the kind that shows up neatly on a balance sheet. Most of this new AI spending is hidden inside private credit, SPVs, special purpose vehicles, joint ventures, and something called circular financing. Circular financing is like a money merry-go-round, and here's how it works. Let's say NVIDIA invests billions into OpenAI to build better models. OpenAI takes that money and signs huge cloud computing contracts with Microsoft and Oracle to power those models. Microsoft and Oracle then buy billions worth of NVIDIA GPUs to meet demand. NVIDIA reports record profits, reinvests again into OpenAI, and the cycle repeats. Money moves in a circle, everyone's revenue looks higher, valuations go up. But the real cash profits? They're much smaller. It's like the Three Stooges' "I owe you $10" skit. Everyone owes everyone else, and somehow they all think they're richer. That feedback loop makes the entire US economy look stronger on paper than it actually is. But here's why this matters to all of us. Because these 10 companies represent such a huge share of the market. They've become too big to fail. If AI investment slows down, the economy slows down. If the economy slows down, markets drop. And when markets drop, politicians panic. That's why when Sam Altman said the US government might eventually have to act as the insurer of last resort for AI, he wasn't joking. He was just saying the quiet part out loud, because in reality, if the US wants to win the AI race against China, Washington can't let its own AI champions crash. That's the logic. So we have trillions in spending built on debt, circular financing making numbers look stronger, and an entire government quietly motivated to keep the illusion alive. That's not just an AI story. That's a market story, and it explains why even though the economy looks good, wages are lagging, inflation's sticky, and yet the stock market keeps hitting all-time highs. A huge part of that strength comes from AI spending, and according to Deutsche Bank, if it weren't for AI right now, the US would already be in a recession. Let that sink in. Now think about what major investors are doing. Warren Buffett has been quietly selling billions in stock. He's now sitting on over $160 billion in cash. the biggest cash pile any investors ever had. Then there's Michael Burry, the guy who called the 2008 financial crisis. His latest filing shows that 80% of his portfolio is betting against Nvidia and Palantir, two investors who almost never agree, both saying the same thing in different ways. This market might be priced for a future that doesn't exist yet. So, are we in an AI bubble? Well, before you decide, let's zoom out and look at how your money, yes, even your boring index fund, is part of this whole feedback loop. Remember, the S&P 500 is a market cap-weighted index. That means the bigger a company gets, the more space it takes up in the index, and the more money automatically flows into it when people buy index funds. So if Nvidia's stock price goes up, its market cap goes up. Then every new dollar that flows into the S&P 500 sends an even larger slice to Nvidia, pushing it up again. That's the passive investing feedback loop. It's self-fueling, and it's one reason why just 5 companies now make up about 30% of the entire S&P 500. So, combine circular financing with passive investing, and you've got an economic flywheel where valuations keep inflating, even if real profits don't. That's powerful, and also dangerous, because the higher it spins, the harder it falls when it stops. But hey, before we go deeper into what happens next, do me a quick favor. If you're learning something new so far, tap that like button. It really helps the channel. And if you haven't yet, subscribe so you don't miss part 2. All right, let's talk about the next part of this story. Bitcoin, liquidity, and what all of this means for where money might flow next. Now that you understand how the AI economy is spinning, let's look at what's happening around it, especially Bitcoin, interest rates, and liquidity. Because while tech stocks have been rocketing higher, Bitcoin's been slipping, and that's weird. Usually they move together. So what's going on? Let's break this down using 2 big forces that drive markets. One is technical, the other is macro. The technical force is what you see when people draw charts, lines, and patterns to predict where prices might go. The macro force is the big picture stuff, like government policy, central bank actions, or global tension. Both matter. For Bitcoin, a lot of traders focus on something called the 50-week moving average, the average closing price over the last 50 weeks. Historically, whenever Bitcoin stayed above that line, it was in a bull run. Whenever it dropped below it, that marked the start of a long cool-off, and recently, it broke below. That's one technical sign of weakness. When enough traders see the same pattern, they all sell together, and that becomes self-fulfilling. But the second, and maybe more important, explanation is macro. We're in what economists call a liquidity transition. Here's what that means. The Federal Reserve has been in quantitative tightening, or QT, since 2022, slowly pulling money out of the system by letting its bonds roll off the balance sheet. But recently, the Fed said it would end QT earlier than planned, around December 1st. At first glance, that sounds great, right? Stopping QT should mean more liquidity, more growth, higher prices, but investors didn't cheer. They got nervous. Because when the Fed suddenly ends tightening early, it often signals that something might be breaking behind the scenes, a stress point in the financial system that we don't see yet. Historically, that kind of shift happens right before markets start getting volatile. So even though the Fed says everything's fine, investors are thinking, maybe not. Combine that fear with the overextension in AI stocks, and you get risk-off behavior, meaning people start selling the most speculative things first, and the easiest thing to sell quickly? Bitcoin. That's why many analysts call Bitcoin the canary in the coal mine. When it starts coughing, the rest of the market might be next. Now, this doesn't mean doom, it just means stress, because when liquidity tightens, growth slows, and investors rotate. They move money out of the riskiest corners into safer assets, like bonds or cash. That's exactly what's happening now. It's also why Warren Buffett's record cash pile makes sense. He's not timing the market, he's waiting for better prices. And in a sideways market, that patience wins. Personally, if I were a short-term trader, I'd be watching this environment like a hawk. But I'm not. I'm an investor. That means my focus isn't the next few months, it's the next few decades. So I'm still reinvesting dividends, compounding slowly, and keeping things simple: no margin, no leverage, no chasing hype. I'm also holding more cash than usual, not because I think a crash is guaranteed, but because cash gives flexibility. If the market stays sideways, dividends will keep paying, and that's where the power of time shows up. While others stress about daily prices, dividend income quietly compounds. Now, what about AI itself? Is it a bubble? Maybe. But even bubbles can create lasting revolutions. Think back to the dot-com bubble. Everyone thought the internet would change the world, and they were right. They just got too excited too early. When that bubble popped, the weak companies disappeared. But the survivors, Amazon, Google, Apple, built the foundation for everything we use today. I could follow the same path. So, if you've got 20 or 30 years before retirement, the short-term noise probably won't matter much. Staying invested, staying diversified, and keeping your time horizon long might end up being the best strategy, because when prices argue with each other, dividends and time have the final word. So, whatever happens next, whether AI keeps soaring or cools off, whether Bitcoin rebounds or stalls, the long-term trend of innovation doesn't stop, but short-term. Expect turbulence. If you found this breakdown helpful, hit that like button. It helps more than you know. And if you want to keep up with everything happening in the markets, subscribe so you don't miss what's coming next week. Thanks for watching. Take care of your money, and I'll see you soon. So, combine circular financing with passive investing, and you've got an economic flywheel where valuations keep inflating even if real profits don't. That's powerful, and also dangerous, because the higher it spins, the harder it falls when it stops. But hey, before we go deeper into what happens next, do me a quick favor. If you're learning something new so far, tap that like button. It really helps the channel, and if you haven't yet, subscribe so you don't miss part 2. All right, let's talk about the next part of this story: Bitcoin, liquidity, and what all of this means for where money might flow next.